Hi, I'm Mrin Agarwal. I'm a financial educator and am working towards helping women achieve financial success through financial education. Welcome to the She Invests podcast series in association with SBI Mutual Fund, where I talk to a woman who has taken charge of her financial life and share with you how mutual funds helped her in her financial journey. Today, I have with me Kavita. Kavita is a veteran in the finance field, having worked for over 22 years in various roles. She's currently Director of Finance at a very large IT company. And nice to have you here today on the show, Kavita.
Thank you, Mrin.
So, Kavita, I'd like to start by asking you, how did you really start your financial life?
I think it was more so after marriage and about 5 to 6 years of my experience, because at that time it was of expenses and maybe, giving back to the parents. But after marriage, when I saw the expenses coming up and then I realized that, in future there are going to be more expenses coming up, that was a startling point.
So how did you start? Because at that point in time, you're talking about maybe the early 2000 era, and what were the sort of investments that you made at that point of time?
That was again a very interesting era, probably because I was new to the stock market, though I had theoretical knowledge about it, but I had not had a practical experience. I started off slowly with debt, and then when I realized that, debt can take you to some extent, what real earnings, or if you have to really make your money work, then it has to be stock markets. And that's where I thought and read about mutual funds and slowly, steadily started with monthly SIPs and got into mutual funds.
So typically, we see it the other way around, that we find a lot of people who tend to invest into stocks directly, and then over a period of time they figure out that it's not something that they can manage, and then they get into mutual funds. But in your case, you actually looked at mutual funds much early on compared to investing in stocks directly. And why was that?
That would be because probably in the IT company I was working, few of our friends were doing some investments and doing some reading. That gave us this idea that stocks is good, but are you able to take out time, monitor it, read through the stock? If you do not have that, and those are the days when you're really working very hard and job is your first priority. So that's when we realized that why don't we go to mutual funds? Because there is some team who's already doing that research. They're already doing a lot of work in taking out the stocks. What you need to do is, what's your risk appetite? What type of risk you would like to take? And just go take that type of a fund and invest. So that interested me, that I just have to depend on somebody or some fund house I believe in, whose track record has been good, and I go ahead and invest. And then I had options. Do I need a debt fund, or do I need a high risk fund, or I need average fund? So I had a plethora of fund options available, and it was just to select a fund, and then it gave me an option of going slow. Probably I started 5,000 and then took a larger amount and then went ahead further. That's how it helped me invest in mutual funds.
What are some of the mistakes that you think that you made in your investment journey?
I would say the rule initially, as I started working, I followed an 80-20 rule wherein 80% of my salary was getting spent and 20% sort of I used to give back to my parents for savings or whatever purpose. But when I started really thinking about investment, I went to a rule of a 60-40, wherein 60% is for the family but 40% for investment. However, that decision of 60-40 came pretty late in my investment journey. If I had stuck to 60-40 right from the day I started investment, that would have made a lot of change in my total corpus which I have saved today. We always think that, okay, let me start with 5K or 10K, but we never think that, no, if I'm earning 100 rupees, I need to ensure 40 or 50% of that amount should just go into investment. That is for my future, or that is for my family. If that rule, if I had adopted, probably the corpus would be much, much bigger, and it would have helped my financial planning overall.
It's so interesting that you're saying that, because this is one of the most common things that we see among the young generation today, that most of them are not even able to save 10% of their salary. And we keep talking about the fact that you need to save at least 30 to 40%. And I know that you are trying to drive financial wellness as well, probably among your team. So what are you seeing among the young IT crowd these days?
That's what I have gone through. The same thing I see in my freshers who come to the organizations, all the young population, they do not want to talk about investments. They just want to talk about vacations, and now going abroad vacation is a big thing happening. So all of them are planning about vacations and spending on new gadgets available. But somehow in the discussions, what we do in the office, I try to bring up the point to them that investment is important. If you invest today, it's much, much easier for them to build up a corpus than starting it at the age of 40 or 45. That's the type of probably knowledge sharing or information I try to give it to the corporate freshers. So in some of the discussions, when we discuss about what the investment patterns they are doing, they are mostly into deposits or debt funds. But I argue on the point that if they are not looking at equity mutual funds, the diversification doesn't happen, and there is no way they will grow their money. They will not be even beating inflation, which is where they realize that yes, they are making a big mistake. But finally, they go and make that change in their investment pattern is to be seen.
And Kavita, I know that you've been investing in various funds over a long period of time. What are some of the categories of funds that you've actually chosen for your investments?
So I look at a very long-term view. My investment strategy has always been long-term, primarily because right now I know I can take care of my expenses, but I would need funds, say, down the line 10 years or 15 years time frame. So I always prefer large cap. They are very risky, but good on return. So I usually prefer large cap and multi-cap funds.
Any reason that you haven't gotten into mid-cap funds?
Yes, probably they are good mid-cap funds. Of late, I have invested in them. Probably 5 years back, I have not invested much in them. Now I have taken an exposure because it's always good to diversify. So I do have exposure now with large cap as well as the mid-cap funds.
That's good to know, Kavita. I'd like to end by asking you to share with us 2 key takeaways of your financial life.
I would say out of so many years of experience and having read and heard a lot of good investment bankers, I feel most important one key learning is that investment and insurance should be kept separate. You cannot have investment clubbed with insurance and then say that, okay, that's my financial planning. At least for youngsters, if you keep these two things very clear, that when it's investment, just do investments. When it's insurance, go pure for insurance. Your financial planning would be perfect.
Mm-hmm.
So that's one key takeaway. The second big takeaway for me would be that take a long-term view for your investment.
Mm-hmm.
Why I say this is whenever the stock markets are falling, that is the best time to invest. And if you're investing in mutual funds, you don't even have to look at the stock market. You just keep investing and money will work for you, right? Those are my key takeaways over the period.
All right, great. What I liked about Kavita's financial journey was the fact that she started planning her financial life early on. I would give some credit for that to the fact that she is a finance professional. However, what I liked more was that she admitted that she had made some mistakes and she did course correction to it pretty quickly. So that's really wonderful to know. The other bit, of course, since I'm really passionate about this, I'm really happy to see that there's someone else who's also trying to spread financial education and financial literacy to whatever level she can. So thank you so much for being with us, Kavita, today, and best of luck with your investments.
Thanks, Mrin. It was great talking to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.